This is Richard Peers from Finextra TV, and today I'm joined by my guest, who's Martina Macpherson. She's Senior Vice President at Strategic Partnerships and ESG Engagement at Moodys. Hi, how are you today?
Very well, thank you, Richard.
Thanks for joining us. Now, you've done quite the background. You've done asset management, investing, indices, AI, teaching, and you've even written a book on bee extinction and biodiversity. So you have got the full spectrum of information that we need to talk about today. Tell us a bit more, though. I've been a bit glib. Tell us a bit more about your background and yourself.
Sure, with pleasure. So it's fair to say I'm an ESG hybrid. I've worked, as you stated, across the, so to say, investment value chain on the buy side, on the sell side, in industry, and also in academia. And I'm leading an NGO, the Network for Sustainable Financial Markets. So it's fair to say that I've developed quite a broad understanding in leading ESG policy and market developments and where these are making an impact. Currently, as you said, I'm the Senior Vice President and Strategic ESG Engagement and Partnerships at Moodys, and I have been holding a number of these ESG leadership roles. For instance, I was the head of ESG indices at S&P, Managing Director of Sustainable Investment Partners, and the Vice President of ESG at MSCI. So that means, over the last 20 years, I've gained quite an insight into the multiple sustainable finance and ESG associations and working groups at a UK, at a European, and at an international level. So it's fair to say I've been working with leading decision makers and influencers, and it's fair to say that I've been setting, hopefully, and shaping some of the trends that we are now seeing in the industry.
Fantastic, and what a great perspective to have. So we're reaching this crisis time now. We've really got to make things accelerate and happen fast. So that's what we want to talk about a bit today. But Moodys, we all know Moodys. But what is your role? Just tell us, what is the role in ESG, and what has brought you to this role? What issues, opportunities do you think that you can impact on in this new role at Moodys?
Sure. Maybe one step back, a bit more about our market. The ESG investment market is now standing at more than $30 trillion. Wow. With ESG funds, right, seeing significant inflows, especially also in the first quarter of 2020, regardless or maybe linked to the COVID-19 crisis. And this is according to a recent report by Morningstar. In policy and market, we have seen a shift from standards to taxonomies, from voluntary to mandatory disclosures, and from principles to rules-based approaches when it comes to ESG. So at Moodys, we see our role as an active market participant, as a leading voice when it comes to providing trusted ESG data and supporting innovation, integration, and harmonization of these different efforts we are seeing across policy and markets. We clearly see the need and support these ambitions for more alignment, for collaboration, and for more transparency of ESG information and standards to actually enhance what we say better and long-term decision making. And interestingly, Moodys plays a dual role here as an ESG data reporter, producer at an entity level, when we are reporting on ESG information, and of course as an assessor of ESG data and information for integrated and standalone ESG products. Just to give you an idea, at the group level, we offer ESG data, scores, tools to serve the demand for financial and dual materiality assessments in ESG by ourselves and supported by the ESG affiliates Vigeo Eiris and 427. And we systematically evaluate climate change and physical risk data in that context. In Moodys Investor Services, the rating agency, it is our aim to create more transparent, integrated ESG and climate risk assessments for credit analysis. And then in Moodys Analytics, we have developed climate change risk modeling scenarios and also stress testing. So that means as an organization, our ambition is to walk the walk from an entity and from a products and services perspective, and to contribute regularly to projects, consultations, and working groups in close collaboration with colleagues from the CFO, CSR, and from the various business units.
Martina, that's fantastic. Thanks so much for telling us that. That's a broad range of services. But let's make it real. Tell us a bit about a kind of customer case study or something which, you know, defines what you're doing and helps us understand that a bit more.
Sure. Very fair assumption. There are multiple challenges here in our industry still, Richard, and it's up and foremost definitions around materiality. You know, should issuers and investors look at single, that means financial, or dual, or even issue-specific consideration or considerations? Should we look at the standardization of information? You know, for instance, when we look at scenarios, and how do we define these? And then comparability and consistency of information, you know, in the context of time horizons, the different type of reporting, disclosure, information sources that actually issuers / companies are using. And then last but not least, of course, forward-looking perspectives. You know, is this really what we're currently undertaking as an annualized effort of collating information? Is this really sufficient in order to identify the trends, opportunities, and risks of the future?
Yeah.
So let me highlight, as you just said, a brief case study here that was done by Moodys Investor Services in 2019 to highlight the challenge of defining what's really financially material in this context. I mean, we looked at a broad array of companies, a sample of 28 Moody's rated US and European entities in environmentally sensitive industries. And we found in the context of companies' climate-related disclosures that these disclosures seldomly reveal potential financial impacts, not to even mention stakeholder impacts in the context of what we define as dual materiality. So climate-related disclosures generally linked to TCFD, the Climate Risk Governance Framework, are on the rise, and they're reflecting a strong board and management attention. About 80%, by the way, of the companies that we sampled cited climate change as affecting their strategic decision-making. But the quality and depth of reporting across these companies still varies very widely. So as a result, it is difficult to assess or even compare potential climate-related financial impacts within a sector or across sectors. And there's a wide variation in what companies report, as well as the materiality thresholds they use to assess climate change impact. And last but not least, you know, disclosures seldomly quantify the potential financial impacts of climate change themselves. So ultimately, only 2 of the companies that we assessed linked their climate expectations to future financial impacts. So referencing a long-term scenario did not correlate with the publication of financial impact of climate risks or opportunities. So that means there's still a disconnect, not only linked to our study, but TCFD has sampled these organizations themselves in their latest 2019 report. And that just shows you the need for more comparability, for more consistency, and more in-depth quality of information.
Yeah, absolutely interesting, and I think that's so true. So what is the vision of you? What's the vision of Moody's in terms of, you know, this future, the provenance of financial, extra financial data in investment portfolios? Say, you know, how do you see that world panning out as a vision for fixing those sort of issues you've highlighted?
Yeah, very good question. I mean, one of the points are that we need to move away from just backward-looking information and try to capture real-time analysis to inform decisions. So ultimately, what has happened that there's a lot of information out there, financial information on past and present performance. But there's a need for more transparent information on also forward-looking perspectives, as we highlighted. And this is becoming a key prerequisite for effective decision-making in capital markets. So companies worldwide are increasingly being encouraged to place more emphasis on providing a broader perspective on time horizons and on forward-looking orientation, and ultimately to report on a trajectory of change. But there still is concern amongst these organizations. They fear that the publication of forward-looking information could compromise their competitive advantage, for instance, or expose them to certain risks. Others think the quality of information provided could provide legal and regulatory sanctions. So what is more widely understood now, and there's research in the wider domain in our space on this, is that companies who approach reporting with the right mindset, and that is the one of transparency, will have a real opportunity to leverage reporting to increase investor understanding and to gain investor interest. And so, like any new initiatives, these demands will bring a number of risks to companies that fail to prepare adequately for them, but it should actually bring real business benefits, notably enhanced business understanding, governance, and board effectiveness, improved relationships with key stakeholders, and heightened efficiencies flowing from the proper alignment of reporting and communication strategies.
Right, indeed. So that forward-looking approach, that real-time approach, I'm a big advocate of. When you look at that and you think about making that operational across, listed and unlisted firms, and you've touched on a few of the issues there. What's going to get us to sort of real momentum, so that becomes, as you say, past the barriers, but actually delivering the insight on the forward-looking business and the forward-looking risks.
So it's fair to say, that is an increasing focus and has been an increasing focus on listed companies. We look at the EU Directive 2014/95, the up-and-coming EU Non-Financial Reporting Directive, and other policy and regulatory-led initiatives that are trying to encourage listed companies of a certain size with a certain number of employees to disclose information on ESG and diversity. Interestingly, this focus is slightly shifting. In the recent EU NFRD consultation, the EU Commission has been asking when, how it is appropriate to actually lower the threshold when it comes to company size, employees, or market capitalization. And there is an increasing momentum side by side from the non-listed, the private space, and multiple initiatives, frameworks, even data providers such as Preqin and others that are actually focusing specifically on looking beyond the hood when it comes to information from entities in the non-listed domain. And likewise, investors, up and foremost initiatives by the PRI and others, are encouraging this movement and are also mandating for further disclosure. Currently, by the way, all signatories, may they be in the listed or unlisted space, they have to report as of this year in line with TCFD on climate change risk. And as of next year, if I'm not mistaken, alongside the SDG, the Sustainable Development Agenda, and when, how they define impact.
Yeah, and that's really interesting, isn't it? What's the role of technology, though, in all of this, and alternative ESG data, and how do we get that into the mainstream? As you say, if we're moving from climate change, which is relatively measurable, into this sort of the S&G, is there a role for this sort of alternative data?
Good questions. Maybe let me take that in two chunks. So first of all, there's definitely a link between AI, ESG, and data. And what we've seen is that the journey to digital transformation has already started. Decision makers at large in financial and in non-extra financial industries are using more specific linked processes, fintech or AI linked, to provide more simpler and efficient processes around data and decision making. And there is ultimately now as well a strong focus on trusted governance, data and information and infrastructure, which has a key and leading role to play. That means empowering data scientists through data governance, breaking down information barriers and biases, for instance, as we have seen through self-reporting, and modernizing information architecture for business-ready and real-time solutions, and data, in this context ESG data, which is encouraged through AI-enabled ESG screening, for instance. So ultimately, and at a glance, better use of technology and innovation can actually act as a strategic enabler for ESG analyses. That means, we need now to better understand and being able to analyze the interconnectedness of real-time systemic ESG risks and opportunities and information linked to this. And AI and fintech in turn can act as a strategic enabler to structure and align ESG information and to establish links for screening and analysis on the one hand of maybe macro trends and risks, and on the other hand, to improve investment decision making.
Yeah, it's
they are, sorry.
No, carry on, please.
They are, of course, as you highlighted, still challenges to get alternative data and sources into the mainstream. So that's the big second statement here to make. But to create real-time inputs, we are not getting around the fact that we need to ultimately triage annualized and real-time information to provide, the past, present, and forward-looking perspective. And as demand for ESG investments actually is accelerating, AI-driven sustainability data offers the opportunity to create innovative solutions that reflect insights into hidden or potentially hidden risks and opportunities in the mass of this unstructured data.
Yeah.
And last but not least, we shouldn't forget that a lot of financial innovation for ESG and green finance interconnected with fintech or AI has already started. We are seeing increasingly AI-powered data providers, and we are seeing initiatives by investors and for investors. For instance, the Green Asset Wallet initiative and an SDG AI-powered decision maker tool for investors, all coming out and to the fore right now.
Yeah, that's. I think that's really important, and it's a comprehensive overview. The technology is often there, and yet it doesn't get used. In a way, we're in the middle of a perfect storm here in many dimensions. Everybody's familiar with those probably. So does this make, the here, the now, a real time of change for you? Do you think that we can really turn all of these switches you've spoken about, policy, technology, new financial instruments, new data, etc.? Is this the time for change?
I think the time is here now, Richard. ESG has definitely moved into the mainstream, investment mainstream. And, there was prior to the crisis a strong focus, still is, on predominantly climate-related, E-related risks versus social and maybe impact-related issues, more likely opportunities and impact. But during the COVID-19 pandemic, and we have done a bit of research around this and had multiple discussions with other key stakeholders, it has become apparent that companies need to take action to curb actually, the pandemic's effects, to establish operational resilience, to build innovation, and to foster investment in people, research and development, and technology. And hence, these sort of S factors are becoming increasingly important to determine the long-term value creation and success, hence operational resilience of these organizations. So that means, downside protection as well from risk was the key angle for many ESG proponents for a long time, backed by the thesis, that ESG analysis enhances the analytical perspective by scrutinizing more qualitative value drivers. But the debate is clearly now more shifting towards, as I highlighted, opportunities management and impact. And there are many now positive performance signals that show us that ESG funds are providing that additional layer of positive performance that's so much sought after and looked for. But again, just to highlight, this is not just a recent or short-term phenomenon. I've seen many studies by Harvard Business School, by University of Hamburg and Deutsche Bank that actually found over time a positive correlation between corporate social performance and corporate financial performance. And a most recent report by Morgan Stanley also found, and it assessed 11,000 funds from 2004 to 18, found, that there's statistically no significant difference in the total returns of sustainable funds compared with their conventional peers, but a 20% smaller downside deviation. So here's your investment case.
Yeah, so I think, as you say, it is a time. You know, we're hearing from Christine Lagarde and Mark Carney, and we've heard from Al Gore for years, and many, many more. And it's always sort of seemed to be moving from the talk to the walk. The performance is coming through, as you've just said. The technology is there. So let's hope so. Finally, just tell us, what next for you and Moody's. How are you going to help to get ESG data and initiatives out to the market at scale? What's coming next from you guys?
Yes, in 2019, Richard, we acquired several ESG-related companies, to recognize that ESG considerations are increasingly relevant to issuers, investors, and counterparties who seek to understand and measure ESG factors. And we took major stakes in Visio Iris and 427, and these two affiliates now contribute significantly to our thought leadership, positioning, and product and solution building efforts. In 2020, we have established a new ESG leadership team and a dedicated effort around global outreach and engagement, which I lead. And we bring together ESG experts from across the firm. We identify strategic partnerships and areas for collaboration and opportunities management when it comes to thought leadership, when it comes to strategic efforts and positioning, of course, for the firm. And we roughly engage with more than 50 key ESG and CSR bodies and networks, and regularly support consultations, working group efforts, and projects. For instance, most recently, the EU NFRD's non-financial reporting disclosures consultation that's actually shaping our market and future as we speak. And for us, of course, as a firm. And for 2021, we are working on a couple of exciting developments for ESG solutions and more innovation. So watch that space.
Fantastic. Outstanding. Really great to catch up with you and to get the sort of wealth of your experience and also understanding what Moody's is up to. I mean, it's very hopeful that the work that you're going to do is going to make a real difference. So, Katrina, thank you so much for your time, and we look forward to talking to you again shortly.
Thank you, Richard. Speak soon.